What's good, YouTube? This is your boy Star Gen Z, and I'm back again with another video. So today we'll be talking about market structure. So when we talk about market structure, the market doesn't just move randomly, right? Market structure is a way that the market usually moves that have been tested and proven over many years. So that's what I'm gonna be diving into today to show you how the market actually moves, how the market is usually structured. It's usually structured because in the market consists both of buyers and sellers. That is, if there's demand in the market, there must also be supply, right? Without further ado, I'll just dive into my screen and explain to you how the market structure actually works. I'll just be using this representation to explain how the market structure actually works. In the market structure, normally you have an uptrend and a downtrend. So in a market structure, normally there are three ways the market can be moving. You have an uptrend, a downtrend, and a consolidation. On an uptrend, it means the market is going up. There are different ways we can explain it. There are actually three ways we can actually explain it. If the market is going up, that means instead the market is buying, the market is in an uptrend, or the market is bullish. And in the other side, if the market is selling, or if the market is going down, we can explain it in three ways as well. It means the market is either selling, bearish, or on a downtrend. The market can also be consolidating. If the market is consolidating, it means the market it's not bullish and it's not bearish. That means it's just moving in between a certain price. We can say the market is either ranging or consolidating. So if the market is bullish, you'll be seeing the market creating higher highs, higher lows, higher highs, higher lows, higher highs, and all the rest. When the market have this push, we call it as a higher high. When the market pulls back down, this one will be known as a higher low, higher high, higher low. And that's how the market can actually stay bullish. So if the market is bullish, it means the market will make an impulsive move to the upside and a correctional, an impulsive move and a correctional. So this impulsive move is called as a higher high. Then this retracement will be called higher low, have a higher high, higher low. And that's how this in a bullish scenario, if the market is bullish. On the other side, if the market is bearish, you'll be seeing the market creating an impulsive move to the downside, correctional, an impulsive move to the downside, correctional. So when the market creates this impulsive move to the downside, we'll call it as a lower low. Then this correctional to the upside will be as lower high, lower low, lower high. I hope that explains just the basic way the market usually moves. You see the market pushing up, down, up, down, up, down, as I explained. So when the market is having this push, it's called a higher high. When it makes this retracement to the downside, we name it as a higher low. Now, when the market breaks this recent high, it's known as break of structure, BOS. That means the market has broken this structure to the upside, which will now be known as break of structure to the upside. So for the market to stay in an uptrend, that means the market is breaking structures to the upside, right? So eventually, that's how the market will continue to be bullish, by breaking these structures, breaking these higher highs, to the upside, until this recent lower higher low, it's broken to the downside. We'll now call it a change of character. It will now be known as a change of character. So that is when the market is shifting from a bullish trend to a bearish trend. We'll call it as a change of character. So when the market changes its character from a bullish to a bearish market, we first of all notice by a change of character. That means this change of character is trying to tell you that this market is changing from a bullish market to a bearish market. So when the market changes its character, for it to stay bearish, it will now start creating lower lows and lower highs. So this should be lower high, lower high, lower high. Yeah. So for the market to stay bearish, we will now start creating what? Lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs. Breaking now structures to the downside. So the market, for the market to continue being bearish, it has to be breaking these structures. To the downside, breaking these structures to the downside. And that's how the cycle repeats itself. At times the market will be bullish, at times the market will be bearish, and that's just how cycle keeps on repeating from time to time. You as a trader now is to follow now the market structure and take advantage of it. That's just your work as a speculator. Just know that identifying market structure is very, very important, and it's non-negotiable when it comes to the foreign exchange market. Because when you can actually read the market structure, that's where you understand how the market moves and how you can actually catch the next movement of the market, if it's a buy or sell. How the real market looks like. It's not as simple as it when you are representing it graphically, right? Here the market is bearish. Creating break of structures to the downside. At a break of structure here, break of structure. All these are break of structures to the downside, break of structures. Then when the market break a structure, most of the times it's going to come back to a certain level. It can be like maybe an order block, but don't worry, we are going to talk about order blocks and fair value gaps. So there's actually a lot we'll actually be discussing about. When you break a structure, is going to pull back to a certain level, break a structure, going to pull back. So when you have this impulsive move, eventually you'll be having a correctional, impulsive move, correctional, and that's just how, in this case, this is a downtrend, and that's how the market keeps on pushing all the way to the downside until the market will reach a certain level that will eventually shift from a bearish market to a bullish market. So when the market is shifting from a bearish market to a bullish market, normally this last high that was created, when the market breaks this recent high that was created in a downtrend, we consider it now as a change of character. As I said earlier, when the market creates this change of character, it's starting to tell us that it's changing now from what a bearish market to bullish market. Now when it changes character, we'll now be having market breaking now structures to the upside, make a retest. And so what the market is doing here doesn't actually matters, because this might just be a manipulation. So what matters is until the market will come back to break this high, we don't have anything to be doing with the market structure inside here, right? We don't have anything to be doing the market structure inside here, because what matters is the market have broken this structure. This is a recent high. Until the market have broken this high, the market structure here will be considered as just consolidation. Eventually, it's that it goes back to break this structure to the upside, or it comes back to create another change of character. One thing you should also take note with market structure is that on the higher time frame, a run. So when we talk about a run on the higher time frame, that means this impulsive move on the higher time frame. If this is the 4-hour time frame, it means on the 5-minute time frame, or let me just say on the lower time frame, like on the 5-minute time frame, we are going to see a market structure of this manner. This will be the 5-minute time frame, but on the 4-hour time frame, it will just be like a run. On its retracement, this is the 4-hour time frame, H4, but on a 5-minute, this retracement will look something like this. So it's actually very important to understand how the higher time frame aligns also with the lower time frame. So I'm going to use this USD JPY chart to actually explain to you what it means by a run on the higher time frame. It it's a market structure, it's a whole structure on the lower time frame. So I'm going to, let me select out this section. This is a 4-hour time frame, so we are going to go down to the 5-minute time frame, and I'll show you what I mean. All right, so this is what we have selected from the 4-hour time frame. So if you check on the 4-hour time frame, you see that this is just like a whole retracement, right? But on the 5-minute time frame, you see that this is a market structure. This is a bearish market structure, creating lower lows, lower highs, lower lows, lower highs, lower lows, and like the market structure is actually going down until eventually this high here was broken, creating a change of character. Then the market continued. Then the market eventually reversed here, and it's going all the way to the upside, right? So this is just one thing you should also understand when it comes to market structure, that a run on the higher time frame, a run can be an impulsive move, it can be a correctional. It's a market structure on the lower time frame. So if you have found this video helpful, if you have found this video educative, make sure you subscribe, smash the like button, and share, because on my subsequent videos I'll be talking about other blocks, fair value gaps, market manipulation, and there's just a whole lot of educational content I'll be bringing up just like this one. So make sure you subscribe and stay tuned for my next video.